Okay, well, Robert Sockin is with us. He's global economist at Citi. He's joining in to take some questions. Robert, good to have you with us here. Thank you very much for your time. The market here in India has been very focused on elections, and the outcome is close by for this sort of long-running general election. But globally, what are the most important cues, Robert, to your mind? It's been pretty sanguine overall, right? And risk has been very well behaved. If you look at the US, if you look at rates, dollar, etc.
Yeah, absolutely. And thank you so much, as always, for having me. I think, as you said, there are a couple major risks that we've been monitoring for this year. Election risk has been one of them. So far, this was the big story at the start of the year, the sheer number of people that were going to the polls, the amount of elections we've had. So far, none of these have really rocked the boat in terms of markets or the global outlook. I think we're going to have to wait from an election standpoint as we get closer to November, where the US presidential election is going to loom very large. And I think that is going to lead to a lot of discussion within markets and is going to have very substantial implications on the economic and market policy outlook. Now, in terms of other risks around the globe, right now, as you said, I think the real focus is we've seen much stronger data than we were expecting, at least in Q1. But we've also seen sticky services inflation data. And it really comes down to what is going to happen to the US economy heading into the rest of the year. That was the story in the US to start with Q1. Q2 data have been more mixed. We've seen a little bit of improvement on inflation. We've seen also a little bit of softening in activity, some downside data surprises. And so the real question is, how is that going to suss out throughout the year? Are we going to go into a sharper downturn in the US, or are we going to have a soft landing? What does that mean for the Fed? So that is the focus of our monthly outlook this month. And I think that's going to be the key focus for much of this year.
I think the common narrative now is that, there could be a rate cut coming in September from the US at least, purely because of the way inflation is cooling off. A, would you concur with that we're looking at a rate cut in September? And B, what does this mean for risky assets like equities? Because we're here at a time when we're seeing commodities pick up in a big way, whether it's, silver prices at an 11-year high, gold is surging. Of course, silver is also surging because as an industrial metal, it's picking up a lot of pace, given the way EVs are rising globally. But your thoughts on how to approach it if we're heading into a rate cut by the US Fed in September?
Yeah, absolutely. So first, on the rate cut side, I think it really depends on the path forward for the economy. As I mentioned, that there's that pathway to a larger moderation, a larger slowdown in growth, and that could open the door for the Fed to cut rates fairly rapidly. Our US team at Citi expects that to be the case and has them starting to cut rates in July and then continuing with 4 cuts this year and continuing with fairly rapid rate cuts later in 2025. Another path, as you said, which seems to be more the market path, is that you get kind of this moderation in growth, but a still resilient US economy. Inflation's fairly slow to come down. And in that environment, I think you get 1 or 2 rate cuts from the Fed, probably 2, because 1 would seem like, I think, an odd tenor unless it starts at the very end of the year. So I think a very reasonable path could be a rate cut in Q3 and then a rate cut in Q4. Of course, we'll have to see at the next Fed forecasts how they're thinking about the economy. But I think that's the way the markets are pricing it right now. Now, in terms of equity markets, I think there's a lot of different stories going on, as you noted. It's not just about the path of Fed policy, but it's about the resilience of the economy and also the AI cycle, which we've seen power through the US market and probably is more insensitive to what the Fed does in terms of the long-term outlook and the long-term investment numbers that we're seeing out of that sector. So I think there's a lot of complicated factors for equities that are beyond just the Fed's path. But of course, if the economy maintains its resilience and the Fed starts easing up on policy, I think that's broadly positive for the equity market beyond just that AI cycle. I think if you get a soft landing, you could get even higher broad-based numbers in equities.
Hi, Robert. Good morning and good to see you. When the last time we chatted around 45 days or so ago, you were telling us about how You've upped your growth estimates a little bit for China, and some of those data points were looking a little better than expected. How do you see the China piece coming together? I'm reading a note coming in from HSBC earlier today, and they are saying don't get off this Chinese party too early with regard to the equity markets. Your take with regard to policy action that we are seeing, and how do you approach the Chinese markets?
At the start of this year, we had a forecast for Chinese growth at 4.6%. And then we were surprised by the strength of the economy in the first quarter. As I mentioned, globally, we were pretty much saw upside surprises in almost every major economy, but China was certainly one of the most notable. And we marked up growth to 5% on the year. Now, there have been some shakier data since then. We still think it's a fairly fragile recovery. Parts like the property sector are still soft, while other parts of the economy have been performing better. So it is kind of a dual track or a multi-track economy, but we think there's enough momentum within the economy to achieve something around 5% growth this year, and probably a decent growth prospect for next year as well. And that would point to some attractiveness, as you said, of these Chinese markets. Now, longer term, I do think China faces an enormous number of issues that it has to address that could weigh on the economy. This has to do with dislocation of labor, still very high youth unemployment, aging demographics, unwind going on in the property sector, chronic tensions with the US that are weighing on activity there. So there's a range of reasons to be concerned about the longer term. But I think for this year and probably next year, maybe a few years, there's enough momentum that China can still record a fairly sizable, robust growth.
All right, Robert, we'll leave it there. Great conversation as always. Thank you very much for joining us, and appreciate your views here on CNBC TV 18 as always.